Hello and welcome to the 8th of our ACCA P7 Advanced Audit and Assurance lecture recaps. This lecture was on planning the audit. So things we need to consider when we come to plan the audit. The administrative side of planning. You need to look at the logistics involved. The staff that you have, the geography of the client, where are all of their locations, can you get to them all? Are they all suitable? The timing of the audit, deadlines, have you got the staff available at that time? Tasks and IT, we're talking here about timesheets. Are you keeping timesheets? Are you keeping a fees ledger? Are you on budget, over budget? Staff planning, again, how do you get the staff to and from where they're supposed to be going? Expenses, have you agreed to charge the client expenses, or are you going to suffer the expenses yourself? You'll establish budgets for each area of the audit. Objectives, how are you going to communicate with the client? Is it through the form of letter, emails? How is that going to happen? The audit strategy then will set out the scope of the audit. You'll have covered this in F8, the detailed audit strategy, the scope of the audit. Whereas the plan under ISA 300 gives us the detailed planning of the audit, the details of what's going to actually happen. So materiality. Materiality will be set partly on the basis of a quantitative benchmark. That quantitative benchmark may be 5 to 10% of pre-tax profit. That would tend to be for profit and loss items. 0.5 to 1% of turnover, or 1 to 2% of total assets, which will tend to be for balance sheet items. So you'll probably start with your quantitative benchmark. But the Clarity Project says that materiality is a lot more than that. Okay, we need to consider the elements of the financial statements that the users will focus on. So if the users have a particular focus on one element of the financial statement, that may lower the materiality on that element because they'd be more interested in errors or discrepancies in that area. Also, you've got to consider the nature of the entity. For example, if it is in financial services or that sort of thing. The ownership and financing of the entity. And also the volatility of the quantitative benchmark that you've chosen. At the end of the day, it's a professional judgment, and materiality will be set not just with the quantitative benchmark, but considering the nature of the balance as well, using these things that we've just outlined. Materiality will also have an impact when it comes to the relationship with audit risk that we looked at in our risk lecture. We also need to consider the number of misstatements and whether there are cumulative errors, so whether misstatements in and of themselves are not material. If you add those all up, they may come to a cumulative error, which is just as bad. Okay, so you need to consider materiality at all levels of the audit. So, risks. The definitions of the different types of risk that we have. We have audit risk, which is the risk of expressing an inappropriate opinion. We have control risk, and this is the risk due to weak controls or systems. Detection risk. This is the risk that you've conducted insufficient procedures to actually find an error within the financial statements. And business or inherent risk is the risk due to that type of business. Basically the risks that would be there if there were no controls in place at all. So we need to understand the differences between those types of risk. The examiner also will mention financial statement risk. When they do, financial statement risk is simply the risk that the draft accounts contain a misstatement. Business risks or inherent risks then. There may be external risks. These will surround legislation that you have to comply with, the economy, competition, technology. So if you're assessing a scenario for business risks, try to split them into external risks and internal risks. The internal risks will focus on employees, maybe an old system that's in place, or if they have cash flow problems, or indeed if gearing is increasing. Lastly, fraud also will be an internal business risk. So you've got to consider several things. You need to consider how these risks are actually managed. You need to assess whether the bank is going to continue to support the business. Is there a strong control environment? Is there any litigation coming up? Do they have adequate systems in place? So a scenario question will also often ask you to assess the business risks. If so, look at all of these areas that we're discussing and apply it to the scenario. We also have to undertake a risk assessment. Remember, our audit is a risk-focused audit, so we need to understand the risks that there are surrounding this business. So inherent risk factors will surround management competence and integrity. Also, if there's any pressure on management, this will also increase the risks. The nature of the industry, the complexity of the area, if they have susceptible assets, i.e. that they could be stolen easily. Also, the quality of their accounting system will add or take away from the risks inherent to the business. If they are undertaking unusual transactions, again, this will increase the inherent risk in the business. Control risk factors. Well, the control environment, this will surround the attitude, awareness and actions of directors, the philosophy of management, and the structures and responsibilities within the business. Also, the methods that are used to impose control. Is there strong disciplinary action if controls are not adhered to? So procedures to look at these are procedures that will implement control within the business. Approval and control of documents, comparing controls accounts with records, controls over IT, arithmetical checks, reviewing controls and trial balances, and having reconciliations. Also, access to assets. This is going back into F8. These are the procedures for controls within the organisation. So detection risk factors. What will increase the risk that you don't detect a material misstatement? Well, there'd be some inherent risks that we've talked about, the control risks, and then the subjective nature of the evidence, the fact that you'll have to make judgments on it. So, procedures to undertake in planning. The risk assessment is set out under ACCA 315. You need to undertake inquiries of management, analytical procedures, observation and inspection. The audit then will be, if it is high risk, detailed in its substantive testing, and a more increased sample size. If it's a lower risk, well, you may rely more on analytical review, and you may be able to reduce your sample size. If there's a computer system in place, you need to consider this at the planning stage. The advantages of having a computer system are that it'll have faster reporting, you'll be able to drill down the balances and see where they came from, and there should be a detailed audit trail. Also, this will automate the procedures and enable you to actually check whether they are correct. So that was our lecture on audit